Hi there, Internet. Today I wanted to talk about the humble PE ratio. There are those that say that it is not relevant anymore, but I think that it is quite a nuanced and useful tool. So today I'm going to explain a little bit more about it. Let's take a look. All right, I'm assuming some basic understanding of investing concepts, but this is aimed very much at the beginner. So hopefully it is low level enough that anyone should be able to walk away understanding a little bit more about the PE ratio. So the PE ratio is a way to determine the valuation of a business, the valuation that a market has awarded to a business through its share price. Now, the reason that we need such a ratio is because if you look at a company's share price, for example, let's look at Berkshire Hathaway's shares, BRK.A, these shares are $417,000 per share. Whereas if you looked at Facebook shares, I think they're somewhere in the $300 ballpark. Now, Berkshire's shares are a lot more. The price of the shares are a lot more, but actually Facebook, the company, is larger according to its market cap. So looking at the share prices doesn't really tell us very much about the businesses, how the market feels about them, etc. And this is why the PE ratio came about. So it is a way to not only compare companies to each other using some kind of baseline, it also allows us to compare companies to themselves. So, for example, comparing Facebook now versus itself 10 years ago would be very difficult if we only had the share price to look at. So the price to earnings ratio is calculated by taking the share price of that company, which is the market cap of that company, dividing that by all of the outstanding shares, taking that stock price and dividing it by the earnings per share. And the earnings per share is calculated by taking the net income, so the profits that the company has earned for a particular period. That's net of all expenses, any tax, etc., and then dividing that net income by the number of outstanding shares within the company. And so we take the first number, the price per share, and divide it by the earnings per share. And what we arrive at is the price that an investor is willing to pay per unit of earnings for their company. This is usually expressed in dollars. So if we look at Facebook, we can see that investors are currently willing to pay 28.5 times per unit of earnings within this business. Is that expensive? Is that cheap? Well, let's take a look at some ways that we can figure that out. The PE ratio is quite nuanced. There are many ways to measure it, and I don't think I fully understood the nuances for the first few years of investing. I knew that it was a number that was important, and I knew that a higher value was worse than a lower value, and that it was different across industries and companies. But beyond that, I didn't get it very much. So what I wanted to do today is look at a few different examples. And the first two examples are made up private companies. And instead of talking about massive multinational companies, I'm going to try to bring the concepts home by talking about smaller companies. So let's say your neighbor Carl, he has a car wash, and it's generating $100,000 in revenue per year, and half of that is net income, half of that is profit per year, $50,000. His company, the revenue doesn't grow, the earnings don't grow, and he's fine with that. He's got a lifestyle business, and the earnings are more than enough to cover whatever he needs to pay for in his life. But now he's looking to expand. And so he's approached investors and he's said that I think that my company is worth 2 times earnings, annual earnings. And so I would like you to invest in my company at a PE ratio of 2. So effectively providing this value for the business. So what this would mean is that if you invested in this company, I'm ignoring dilution here just to simplify the entire calculation. So if you were to invest in this business, it would take the company 2 years at this rate of creating profit in order to accumulate the profit, enough profit to cover the cost of the share that you had bought. That's kind of what the PE ratio, this number 2, is telling you. is this a good price or not? It depends. It depends on the market conditions and what the market is looking for. A business like this might be attractive for a number of reasons. Maybe they pay a dividend and they're fairly recession proof. So people are willing to pay a slight premium on annual earnings to become an investor in that business. Now let's look at the second case. Let's say your neighbor across the road, Delilah, she's created a mobile app that's for the doggy dating application. And she's in a similar situation at this point in time. So her revenue is the same as Carl's, her earnings are the same as Carl's, but both her revenue and earnings are actually growing at 100% per year. It's an online business. People really like having their dogs date one another. So growth is going through the roof. She's making a lot of money. And Delilah, because she has this growth in her business, she knows that she can ask for investors to give her a little bit more. So she's asking for a 4-to-1 investment. She's offering shares at a 4-to-1 ratio using her current earnings, which gives her a price to earnings ratio of 4. So looking at this, at the surface of it, if you didn't know anything about these businesses and you just looked at these numbers, you would say 4 is greater than 2. So this should be more expensive than this company. But that's not the full picture, obviously. There's a lot more to understand. You need to understand the business model, the opportunities, and even to some degree the what's happening economically at the time when this offer has been made. All right, so what I've done here is I've created a compound interest calculator, and I've done some forecasting. So for Carl's car wash, he's got no growth in his business. So 4 years from now, with no growth, he's still going to be making the same $50,000 per year in profit that he has been the whole time. So his PE ratio will remain the same. And here's where I want to talk about forward PE ratios. So you can look at the PE ratio in a number of different periods. You can look at it for the trailing 12 months, but you can also look at it in terms of the future and the forecast earnings. So a forward PE takes the share price today, and then it looks 1 to however many years into the future. And instead of dividing the current share price by the current earnings, it divides the current share price by the future earnings. And so in this case, everything stays the same because Carl's business is more or less static. I'll talk about the PEG ratio in a moment, but let's just leave it for now. Delilah, on the other hand, so she's been growing her earnings at 100% per year. That's going to be tough to maintain. So let's say she continues to grow the business, but now on average over the next 4 years, she averages 70% per year. And this means that she's able to, by the end of this 4th period, she is making, instead of $50,000 per year in profit, net income, she's now making $417,000 in net income. And what that means is if we take the current share price and divide it by this potential forecast earnings, her PE ratio actually goes down and becomes a lot lower than what Carl's would be in this forecast scenario, making her business significantly cheaper. So we've already seen a few things about the PE ratio. There are different ways to, the measurement is the same, but the data that you input into it is different. And we need to be especially considerate of business growth. And that's, and now I'm going to touch on the PEG ratio. So I think the PG ratio was invented by Peter Lynch, and it is a way to account for businesses that might have a very high PE ratio, but actually their earnings growth is also very high. So the market tends to award high growth companies higher PE ratios because they anticipate their growth. So we need to look historically to see if that growth story is there, and then we need to look at forecast growth in earnings. And we need to trust the management a little bit when we look at the forecasts. But if we do trust those, then we can say that next year, we think that the PEG ratio, which is the PE ratio divided by the percentage growth in earnings, is going to mean that this company is looking good. Now, PE ratios work such that a higher PE ratio means that the company is more expensive than a lower PE ratio in general. The PEG ratio has the inverse relationship. So if PEG ratio is less than 1, that company is generally pretty interesting to look at. It means that the growth in earnings is outstripping, is higher than the PE ratio itself. If you can find companies that are below 0.75 or 0.5, then you've really got a diamond. You don't find them very often at the moment. Or if you do, there might be something that's a little bit wrong with the business. But when you find a company with a very low PEG ratio, they're usually a company that's worth a little bit of investigation. All right, so would the market be willing to take up Delilah on her offer in this case? I think they probably would, given that the growth of the business, because they would be buying in at a fairly low valuation, and the company, because of the growth, is growing very rapidly. So they pay what seems to be a high price, but actually the growth in the company means that the high price that they paid, in retrospect, if the forecasts play out, mean that price was actually very, very cheap. Okay, when you are looking at PE ratios, I've mentioned a few different perspectives you might want to have already. So you want to look at the snapshot point in time. You might want to look at the forward PE ratio. You want to compare the company to other companies, but you also want to compare its PE ratio to itself. So I'm just looking at Amazon over here, and Amazon always runs quite hot in terms of PE ratios. But if we look back historically over the past 5 years, we can see that the current PE ratio for Amazon is actually one of the lowest for that period. Now, this becomes interesting because companies tend to revert to the mean in terms of their PE ratios. Revert to the mean means they return to the average of the PE ratio over a long enough period. So Amazon is looking pretty cheap by this measure, if only for the fact that it is likely to return to the mean. I mean, I don't have the exact mean. Mean is another word for average. I don't have the exact mean here, but just eyeballing it, it looks as though Amazon's probably going to increase in price just to revert to the mean. So we need to look backwards, we need to look forwards, we need to look at the trend for the current company versus its current spot price, let's call it that. A few other things that we would want to look at when looking at the PE ratio is how a company compares to other businesses that are like it. Not just in the same industry, but also probably the same size. So it's hard to find a company that you can measure exactly against the likes of Apple. But the PEG ratio, I've taken companies that create hardware here. So you should be looking at other companies within the same sector for whichever company that you're looking at, and try to determine where it is against its competitors. It might have a high PE against its when compared to the competitors. That doesn't necessarily mean that it's overpriced, though. It might just be that that company is actually growing faster. It's a better business than its competitors, and so the market is awarding it a higher multiple. Although I think Apple is overpriced. So you can look at the forecast earnings, and these help you to determine those forward PE ratios that I mentioned. So because of Apple's forecast growth in earnings through 2021, which are quite high, you can see that the PE ratio drops off slowly over time. We also need to think about the type of business that we're looking at. So you need to compare a company to its competitors, but you also want to look at the sector to determine what is reasonable. So here are PE ratios for these different groupings, and we can see that financials tend to have lower PEs than a lot of the other sectors within the economy. Real estate is looking dangerously high at the moment, but I think this is probably because of the rotation that we've seen to value and the reflation trade over the past 1 to 2 quarters. So having this kind of perspective on the overall sector that the company operates within is also quite useful. For example, banks will have very low PE ratios because the market doesn't expect massive international banks to grow at a crazy clip. Whereas obviously technology businesses can, because they can scale, because their costs are typically fixed at a certain point in time and expansion is usually fairly cheap. depending on exactly what they do. We also want to look at what the current global context is. So there are certain contexts that are going to favor value stocks, like right now. And this is obvious through the PE ratios that have been awarded to these sectors down here. Technology, I don't think, is very unusual, but there are a few others in here that have elevated PEs, I think higher PEs than they usually do. And the last thing that we want to look at is the stage that company is in. So every company goes through a number of different stages. They start out as an idea. They try to find their market fit. If they do, they draw on money. They try to grow, acquire market share. And so they start with nothing, then they grow incredibly rapidly, usually with little or no profitability. Then they become profitable and continue to grow, but probably slowly than they did before. And then they top out at some point when they've saturated the market more or less. And then they become these engines, these big, massive corporations that are just slowly churning out profitability, hopefully, and paying out dividends usually. And then sometimes a business will go into decline, and then ultimately it'll be the end of that business. The reason you want to look at the stage of a business is that will tell you what expectations you should have. So for example, a fintech company in London that had found a good market fit and was expanding rapidly through Europe, that's the kind of company where you might see a very high PE because earnings are being plowed back into that company in terms of expansion. But that might be okay because of the growth and revenue that company is acquiring. So the PE ratio gives you part of the story there, but you might need to look at other ratios like the price to sales ratio to get a more fully fledged picture. So that kind of company, it's in the financial sector. Maybe it's an upstart bank like Starling, but you can't compare it exactly with big international banks' PE ratios because it just doesn't make sense at that point in time. I wanted to look at a few market examples too, just to give you a little bit of a feel for how you might use the PE. So these numbers are a little bit out of date because I actually created the spreadsheet a long time ago, and then I started studying, so I had to put it on the back burner. So these numbers used to be correct, although I don't think they are anymore. So here we have Amazon, big revenue growth, good amount of profit, massive growth in earnings. And the concepts in these private businesses are the same within these very large public companies. So we have a share price at that point in time was about $3,000. So the PE ratio of Amazon was 43. And as I just showed you, Amazon tends to run hot in terms of their PE ratios. So you might look at this and discard it almost immediately. This will almost always be higher than Facebook, Apple, Netflix, Google, etc. But the part of the picture that's not obvious just looking at the PE ratio or the share price is that because of this insane growth in earnings, the PEG ratio is telling us that this price is actually okay. So once again, the PEG ratio here is telling us the earnings growth in Amazon is so high that the company more than deserves this PE ratio, and in fact, it's probably a bit cheap. Secondly, let's look at QD. So QD. So this is another company with very good revenue growth, although I don't think it's been growing in recent quarters, but their earnings growth has also been spectacular. This PE ratio is very, very low, especially for the kind of business it is. So this would get me interested in looking at the stock a little bit more closely. The PE ratio, the PEG ratio is also insanely low. So in this situation, this business has had to pivot a little bit its business model because of changes to legislation within China, and so that has distorted the numbers a little bit. And then if we look at the likes of Tesla, again, these numbers are a little bit old, but revenue growth was high. Earnings growth for this particular period was enormous. And so here we have a PE ratio that's 1,000. That's eye-wateringly high. You almost never see PE ratios that high for large companies. The PEG ratio is telling us that actually the earnings growth is almost justifies this PE ratio, but only as long as this company could sustain that kind of growth. So just as a benchmark, a PEG ratio of 1 means that the earnings growth is the same as the PE ratio. So they're kind of balancing each other out. Anything below 1 is pretty good in terms of PEG ratio, and they're quite rare within anything at the moment. The market has been a little bit hot. And then Apple, we have the big old Apple, slowing growth and earnings, PE ratio quite high, and because the growth isn't great, the PG ratio is the highest of the lot. So very quickly, I'm not going to go through every single one of these, but Amazon, for example, if you took their earnings from this period and we say that it's going to grow 30% per year over 4 years, it means that their earnings, their net profit will 4 years out be 100. I can't remember if these are in billions. So $10 billion. This means that the forward PE, so even though the PE ratio here is quite high, it means that the forward PE for Amazon is only 15. So by looking at that, and if we were to trust this forecast, we would know that Amazon will, and the term here is, grow into the valuation that the market has given it, because this is pretty damn cheap for a company that's growing this fast and is that size. All right. I also wanted to talk about a few alternatives. There are many different ways to value a business, many different ratios that you often need to use in combination, and different ways of valuing a company that you need to use in combination in order to determine if a company is fair valued currently, and what its intrinsic value might be. So one is the price to sales ratio. You might have seen it in a few of the column over here and a few other places. The price to sales ratio is not exactly an alternative to the PE ratio. You would use it when you are working with a company that doesn't have earnings, or the earnings, the PE ratio is very high, and the earnings are, because the earnings are very, very, very small. The reason you would use it is because if a company is growing sales very quickly, that might be part of their plan. So if you have a startup and their revenue is growing hundreds of % per year, and their plan is to use debt to fuel that growth until the point at which they'd reached a certain scale, and then start looking to grow profitability once they'd acquired a certain proportion of the market, that is a valid way to run businesses. Not in all economic circumstances, by the way, but that is a valid way to create and run a business. That particular model has worked very well through the past 5 or 10 years, whilst we've been in a bull run, and especially as debt has been quite cheap. So this is just an alternative snapshot number that you might want to look at. There is also the enterprise multiple. And so this one is a little bit, conceptually a little bit more complicated than the PE ratio, but is probably a more accurate alternative. So the PE ratio, when we've looked at it, we were taking the price, the stock price, over the earnings per share. An alternative view of that is instead to take the entire market cap, because the share price is just the market cap divided by the number of outstanding shares. Take the market cap and divide it by the net income. The enterprise multiple instead says, I'm going to take the enterprise value, which is the market cap, but considering cash and debt, divided by the EBITDA. So instead of dividing by net income or profitability, we're going to look at the profitability before interest, tax, depreciation, and amortization have been considered. Now, why would you want to look at this? For a few reasons. So the enterprise value, because it includes debt, and the company owns that debt, it's a more accurate value of the company. So a kind of analogy here is, if you buy a house and you acquire a mortgage and buy in that house, you would have paid a deposit, and then you would have taken on a whole bunch of debt in order to finance the purchase of that house. That the value of that house is now your deposit plus the debt that you've taken on. It's not just the money that you have taken out of your pocket to buy the house. It is those two things combined together. So that's kind of the analogy that I would use when thinking about enterprise value. EBITDA is interesting because when you pay taxes or the amount of interest that you might pay or receive, those things are dependent on where your business is in the world. So companies are more and more international, or even in the US, there are different taxes per state in the US. So depending on where your business is, you can be paying different or receiving different amounts of interest, and you might be paying different levels of tax. So if you're trying to compare two different companies, they might have different regimes under which they're operating, and those different regimes will distort the net income because of the different amounts of tax and interest that are being applied. Depreciation and amortization also can distort the net income picture because so these two concepts are ways of reducing the value of assets that you have in the business, so physical, tangible, and intangible assets, whether it's intellectual property or whether it's a truck. You buy a truck in year A, you have it for 10 years. Over those 10 years, the value decreases and you sell it for less money at the end. There are accounting principles that allow you to take the loss in value for those things and include them in your accounting statements. Now, the way in which you depreciate assets it depends on where you are in the world, but also there's some subjectivity involved. And so again, these things distort the net income value. So if you add all those things back, you then arrive at a profit position for that company that hasn't been distorted by all of these things, and allows you to more accurately compare company A with company B, particularly if those companies operate in different geographies or if they're global organizations. All right, so EV over EBITDA can be a more accurate representation of the valuation of a company versus the PE ratio. The CAPE ratio is not really a competitor to the PE ratio, it's just a variation on the theme. And you can see here what it does is it takes the share price and it divides it by the 10-year average inflation adjusted earnings figures. The reason that this is valuable is that, for example, last year, when the market had an enormous crash, the earnings for many companies was completely distorted. If you were an airline, you made very little money through last year. If you were a hotel, your earnings would have been completely obliterated. So this helps us smooth out the effects of events that are in the global economy that might mean that the PE ratio is, the 1-year PE ratio is distorted, like it is for a number of companies right now. All right. So that was the humble PE ratio. The PE ratio is just one tool you should be using. You can't use it on its own to determine whether a security is fair value or not. It is a very quick way, because you find it just about everywhere. It's a quick way to determine if something should be interesting, though, and then it requires a bit of a deeper look. The other thing is that there is a lot of nuance involved in the PE ratio. So, for example, if you're looking at the S&P 500 over the past 12 months, the PE ratio for the S&P 500 is completely distorted. It's out of whack because of what I just mentioned, right? The pandemic shut down a whole bunch of businesses. The share prices are anticipating the future earnings of those companies, but the earnings that appear in the PE ratio of the S&P 500 look for the historic earnings, which were awful for many, many businesses. So you need to make sure that you're looking forwards, backwards, comparing a company to itself over a trend, looking within the industry, comparing it to competitors. And that means that this is a tool that is actually incredibly valuable. Even when you find that it's not applicable, it's telling you something about a company. If a company doesn't have a PE ratio, or if the PE ratio is very low, that immediately tells you the company could be in trouble, or maybe it's a high growth company, etc. So I hope that helped. I hope that gave you a bit more of an understanding of the PE ratio, and I'll be doing a few more of these in the coming weeks. Speak to you soon. Bye.